Hello everyone, welcome back to Upside Down Data. Today I want to introduce a new indicator that I've been working on, which I'm calling the Market Direction Classifier. So this is a new model. It's different from any of the other models that are on the channel. So this is different than the trend confidence indicators. This is different than momentum bias indicators. This is definitely different than the upside downside potential indicator. And really what this model is designed to try to do is, in a more macro sense, identify what type of market are we in. Is this a bullish time in the market? Is this a bearish time in the market? And to identify that as early as possible, right? So to be able to say as quickly as is feasible, now we're in a bear market, or now we're in a bull market. And I think it does a pretty good job. So the way that this indicator works, so I'm showing you here the price history of Bitcoin. So I'm using Bitcoin as the example to kind of illustrate this new model. And so essentially the way this model works is that it observes what the asset is doing, in this case Bitcoin, and then it's generating every single day a critical level, a critical price level. That price either needs to stay above to be in a bull market, so that's what would be going on here, or a critical level once it's broken below that the asset would have to stay underneath to remain in a bear market. And then once it would flip above whatever the critical level is, back into bull market, bear market, bull market, etc. And so that's kind of the way what's going on under the hood, is it's generating key critical levels for every single day and observing whether or not the asset is going above or staying below, and then that can indicate whether or not the given trend is likely to continue. So you can see it does a pretty good job of this, right? So just looking at Bitcoin, bull market, bear market, bull market, a little bit of a fake out here, but then very quickly back into bull market. Calls this as being a semi-bearish time in between the peaks of 2013. Back into bull market stance, flips red, green a little bit for this pump here, but then bear market, a little bit of a reprieve, bear market again, and then bull market all the way up through with just a couple little dips into red, but then very quickly reversing itself back up. And then again, mostly bear market here with just some blips up here. Now you might look at these kind of blips here and these blips this here and say, well, that's just the model not working, right? Why is it getting faked out? Well, there's different trade-offs you always have to make when you make a model. So the first thing you have to recognize is that no model is ever going to be perfect, right? And frankly, no model should be perfect, because a perfect model tends to be an overfit model. So if I had created a model here that wasn't ever getting slightly faked out, that might look great, but then it might not generalize well to other assets. And what I'm going to show later on in this video is that this model here does generalize to other assets. So this can go beyond. This is not just an asset that's overfit to Bitcoin, for example. This is a model that's actually generalizable to different other crypto projects. I've actually backtested a number of different ones, and it's worked well for every single one. And so that is kind of the trade-off you always have to make. But I personally would happily take a few kind of fake outs to have a model that I feel is actually generalizable and predictive into the future over an overfit model that maybe would look prettier on the screen here, but wouldn't work as well in the future. And so that was something I just wanted to clarify. I'm going to show you some back testing of this model as well. And the advantage of this is that even though there are these occasional fake outs here, it won't be losing you money. So if you're using this to be basing buy and sell decisions, it's not going to be the case that it's going to flip green and the market's going to crash 20% before it tells you to get out. It'll tell you to get out before you've lost any money in any kind of correction like that. So in the back testing, you'll see that the amount of funds you'd have would remain flat even in this downtrend, even with these couple fakeouts. Just something I wanted to note there. Now, one of the kind of main motivations for me to build this model was that I just wasn't particularly happy with the other models that existed that tried to do this, and more particularly, what a lot of people look at in the crypto space, are a very common kind of cutoff between bearishness and bullishness that a lot of people use, is the 20-week simple moving average. That's something that you see a lot of people talking about all the time. Benjamin Cowan over at Into the Cryptoverse is a big proponent of the 20-week. And I personally just think the 20-week is too much of a lagging indicator to be as useful as it could be, right? Certainly it's not bad. Here I'm just showing you green is when the price is above the 20-week, red is when it's below. And certainly it's not doing a terrible job of identifying bullish and bearish times. But you can see this considerable lag coming off of these peaks here before it'll end up flipping red. And or just any of these times when you're seeing a flip in the market, there's some lag before it actually flips to the other side. And then that's obviously a lost opportunity. That the longer the indicator waits to flip is the more money either you've lost coming off of the top here, or money or opportunity that's lost on the way back up before it flips to go back up. And so just to show the two against each other, so here's the market direction classifier up at the top, and the simple 20-week down here at the bottom. You can see how the MDC, market direction classifier, flips red way more quickly coming off of these tops here than the 20-week does coming down here. And it's also flipping red here faster, flipping red here faster than here. It's also flipping green faster than the 20-week is as well at different points. So for example, here it's flipping green a little bit earlier than it's flipping here, etc. And so, and I'm going to show you in backtesting that this the MDC does blow the 20-week out of the water when it comes to trading it on different assets, that you would have made significantly more money using the MDC rather than the 20-week. So the final thing I want to talk about in this comparison between the 20-week and the MDC before I get into the backtesting is just to show those critical levels. So as I mentioned, the way the MDC works is it's generating critical levels that it's watching for every single day and seeing if the price stays above or below. And then, if it's in an uptrend and it flips below, then the MDC will classify that as a bearish move. It'll flip red. So what you can actually do is you can actually just plot those critical levels of the MDC over time. And then obviously you can compare that to whatever the 20-week moving average would be, because that would be considered kind of the 20 weeks critical levels. Is just simply what its value would have been. And so that's what I'm showing you here. So this is the MDC, which is the red line, versus the 20-week. And I'm calling these critical levels. So again, the green line is just simply what the 20-week moving average was over time. Whereas the red line, this is not a moving average. This is the output of the MDC. So it's just the critical levels it's identifying at every single time. And what you can see is that the MDC will track the asset, and it'll be kind of setting critical levels closer to the peaks. And that's how it's able to identify tops a lot more accurately than the 20-week, because it's able to track that and say that the critical level is getting higher and higher and higher. So once that's broken, then it suggests that the bull run is likely over. And then likewise in the bearish conditions here, it's going to come down and meet price a lot quicker than the 20-week moving averages. And so that's how it's able to gain its advantage, is that it's much better able to understand what the asset's doing and what the critical levels are. Whereas the 20-week is obviously just kind of a brute force thing. It's just whatever the average price was over the last 20 weeks. The MDC is quite a bit more clever than that in the way that it's assessing what these critical levels are for the asset to hold. And that's why it's able to be much less of a lagging indicator. In fact, give you pretty early warning when a bull market is ending or when a bear market is ending. So that's all well and good to say and to look at, but let's do some actual backtesting to see how these two things play out against each other. So what I'm going to do first, what I'm actually going to be doing is showing you first some backtests against just a buy and hold strategy. And the reason I like to do that is that I think, first off, an indicator has to beat buying and holding. So both the 20-week and the MDC would have to beat buying and holding for either of them to be useful. And then the MDC needs to beat the 20-week for it to be useful. Because if the 20-week is better than the MDC, what's the point of the MDC? You might as well just use the 20-week, right? So that's what this is going to be trying to establish or to test the efficacy of the MDC versus buying and holding, but then also the 20-week. So the strategy that I'm going to be testing for both the MDC and for the 20-week is pretty simple. So essentially what you're going to be doing, so the first backtest I'm going to be showing you is the MDC versus buying and holding. So essentially when the MDC flips bullish, when it says that you should be buying, then, or when it thinks that we're entering into a bull market, it's going to flash a buy signal, and you'll just buy with everything that you have at that point, and then you'll sell everything you have when it flips bearish, when it flips down negative. And so then the comparison strategy will just be this buy and hold. And then for both kind of players or traders that we're going to be talking about here, the MDC and buy and hold are just going to start with $100 worth of Bitcoin. And I'm starting this test or this back test at late or mid-November of 2011. So part of the reason I'm doing this is that the MDC is an indicator that needs a little bit of time to fit itself, usually about one big pump and dump for a given asset. So that's why I'm doing here. I'm using kind of the first market cycle of Bitcoin as being that kind of fitting data, and then I'm using the rest of it as testing data here. And all of the data I'm using to feed into this is kind of real-time simulated data. So it's basically calculating MDC price with no knowledge of the future, or MDC values with no knowledge of the future, so there's no possibility of hindsight biasing or influencing these backtests. So there are a couple assumptions that I just want to clarify for how I've constructed these backtests. So the first one is that the MDC trader is going to be buying and selling at the exact critical price that was at whatever the MDC identified for that day. So if the price, crosses above or below, it's going to be buying or selling at the exact level. And one of the assumptions that I'm making there is that, in the real world, it's unlikely for that to actually be done perfectly. It's unlikely that someone's going to be able to nail the exact level and then not get faked out, because, on a given day, price can bounce around some critical level multiple times before maybe it breaks decisively one way or the other. And so essentially what I'm going to do to kind of try to account for that messiness that's likely to actually happen if you're to do this in the real world is just I put in a transaction fee penalty. So I'm using kind of as the base transaction fee, I'm just using the kind of cheapest general transaction fees that are on exchanges right now. So for example, Binance US is about 0.01%, I believe, is what their transaction fees are. So I'm essentially what I'm going to do is just assume that for every single time the trader is trying to buy or sell based on an MDC signal, that they're going to be getting faked out 5 times before they can finally get in whatever direction they need to get in. So it's basically assuming that price is bouncing around and that people are buying and selling out every single time it's bouncing around. It's probably unlikely that it would necessarily be that often, but I want to be relatively conservative here, right? And so that's what I'm doing to kind of try to penalize the MDC person or make this a more conservative test by just assuming that they're bouncing around a lot, so that whatever results we can get, we can assume it might be a little bit more representative of what would happen in the real world than just assuming that they perfectly get in and out every time, which is unlikely to actually happen. So that's just the assumption that I've made there. Yeah, anyway. So yeah, faked out 5 times before they can correctly get into position. Okay, so let's look at the results of this particular simulation. So this is the MDC total value. So again, they started with $100 worth of Bitcoin. You can see right now that they're sitting up, very healthily above that. I think it's around 90 million going to be the total value that we see here in a minute. They are very happily in profit, and they are crushing the buy and hold strategy by quite a bit. You can see that here. And it's interesting to note that the reason this is happening is really what this model is buying, for the most part, is early exits on bearish times. So you can see how once we get up to this peak, it just kind of goes flatlined here, that they're just kind of selling out. And even though there's a little bit of jockeying that might happen overall, they're just kind of flat throughout here, buying back in for this run, then selling, and basically just holding steady throughout this entire bear market. You see the value is not really moving appreciably through this entire bear market. Then they're buying back in for this bull run, and then again, holding pretty much constant throughout this bear market, buying in for the bull run, holding constant, buying in for the bull run, constant, bull, constant. And that's really where you're getting ahead using the MDC, whereas the buy and hold is going to have to be holding through those bear markets. They're not able to, sell high, buy low, which you can do with something like the MDC. Now I'm going to also overlay the cash positions. This just shows you exactly where buying and selling was happening. So essentially when the green shoots up here, that means they've transition their whole position into cash. When it goes back down to the bottom here, that means they put it all back into Bitcoin, all back into And then this is just a little tiny blips of buying and selling, but then holding in cash, buying back into Bitcoin, holding cash, buying Bitcoin, holding cash, buying Bitcoin, etc. That's how you can see there. And we see that the overall return is around 91 million for MDC. Again, starting from $100, so that's pretty darn good. And that's compared to just $1.2 million for the buy and hold person here, which is a frankly absurd 75 times higher ROI using the MDC versus using the just buying and holding. And again, the MDC values I was using to do this are real time. There's no hindsight bias that's possible here. Those values were calculated without any knowledge of price action that happened later. And so this is literally what would have happened if you use this model versus just buying and holding. Now, I think there's going to be a lot of skepticism seeing this number. Fair enough. I'm going to show you another backtest with a completely different asset, Litecoin, in a minute, just to show this isn't something that's just unique to Bitcoin. That's just an overfit backtest, and that it wouldn't ever predict anything for any other asset. So that will come in a minute. But before I get there, I want to show a comparison here of what the 20-week would have done, because that's, again, another critical thing, right? We see that the MDC is absolutely destroying buying and holding. How will it fare against the 20-week if you just use that as your buy and sell signal? So here I'm showing the results if you use the 20-week. So this backtest was set up in the exact same way, exact same assumptions as the MDC backtest, except I'm just using the 20-week. Are we above or are we below as the buy and sell signals? And so the 20-week still does better than buying and holding. It's beating it by 5.8x, so 7 million versus 1.2 million. But the issue is that if you compare the MDC against the 20-week, we can see that the MDC is yielding almost 13 times higher returns than the 20-week. And so if that critical question is, are you better off using the 20-week or using the MDC? Very obviously here in this backtest, it's showing the MDC is better. That there's just no way of arguing that the 20-week is a better model to be using than the MDC based on these results, in my opinion. Okay, so that is what we get with Bitcoin. But as I was mentioning, I think what a lot of people are probably going to respond to this value is skepticism. Like, really? Is it really the case this model would have beaten the market by 75 times? That seems pretty absurd. Will this model just break if you apply it to some other asset, right? Is it really only something that's just overfit to Bitcoin, right? Because that's something you always have to be concerned about with models. If you overfit it to the history of some asset, then obviously the backtest is going to look fantastic. But then if you try to fit it to some other asset, it would just fall apart because the model would be overfit to just idiosyncratic noise of the original asset and not be predictive at all of things that would happen in some other asset. And so the way that I like to validate these models is, maybe start with something like Bitcoin, but then apply the exact same model. Don't change it at all. Don't touch anything. The exact same model to a completely different asset with a completely different price history, very different behavior, and see if it also works. And if it does, that's very hopeful, because that means that in this completely foreign asset, which granted might be correlated with Bitcoin, but the way it actually behaves is very different, that it's actually able to perform in a similar way. So that's what this is here. This is the Litecoin simulation results. So with Litecoin, I did the same thing where I used the first kind of pump and dump of Litecoin to fit the model, and then I'm using the rest of it as test data. And again, this is all real-time calculated values of the MDC over time. What we can see is that, again, it absolutely crushes buying and holding the MDC, about 19.5 times higher return. So starting with $100 of Litecoin back here in early 2015, $142,000 using the MDC, only $7,000 buying and holding. And again, you see the reason for that is really the MDC shows its value in bear markets, right? So in this bull market, it's actually tracking a little bit below because, again, it's trading in and out. There's some fake outs that are happening throughout here. And so it's losing money to transaction fees. And because I'm applying that transaction fee penalty, that ends up kind of getting exacerbated here. Then the second you hit a bearish time, that's when the MDC really pulls ahead. And then every single kind of bearish time after that, it'll just get better and better than buying and holding. And so that's really the kind of the advantage of this model, is that this model is most useful in a bear market, which makes sense, right? Because if you're in a bull market, then the MDC is by and large probably just going to be telling you to mostly buy anyway. And so really it's going to be helping you when the price is dropping, let you know early to get out and stay out, and then when it might be safe to get back in again. And then again, does this beat the 20-week? That's the other question for Litecoin. Yes, it does. So the Litecoin trading on the 20-week still would beat the market by 7 times here, actually better than Bitcoin in that backtest that we did. But if you compare the two against each other, the MDC is beating it by 2.7x here. So again, very much more worth it. So if you're going to pick a model that you'd want to use, you're probably going to pick the one that's doing, 2, almost 3x higher over this time than the one that's not. And again, I should also note that just like how the MDC was getting a little bit behind in this bull market, trading on the 20-week would have also gotten you behind on that bull market as well. So that wasn't something that's unique to this model versus using something like the 20-week. So that's the MDC. It's something I'm still tinkering around with, but I'm pretty happy with it now with these results, and it's something I think is useful. I think I should also clarify that I'm just showing you the Litecoin simulation just for the sake of time. I've actually done back tests on many different assets, I think over 20, and every single time the MDC was pulling ahead and certainly beating a buy and hold strategy. So that's just one more reason why I have confidence in it. That it's not just that it's happening to work with 2 assets, but I've actually seen it with a bunch of different assets. If you'd like to see more backtests on other assets, let me know. Happy to put those up in another video. But really, I'm feeling pretty confident with this model at this point. You know, that these results are very impressive. And even in the real world, you know, there's probably going to be messiness and maybe even more messiness than I've built into these simulations. But if you're beating buy and holding by 75x like the Bitcoin was, or 20x like the Litecoin one, you can afford to have even more messiness and still have it be a very useful model or something that's very useful to be looking at. And so the way I kind of see this fitting is this would be a bit more of a macro picture type of indicator that's a little bit better. That's more kind of specifically tuned to try to identify those more macro trends in a given asset or in a given market. And then you could use other indicators like the trend confidence indicator, which is really designed to try to give early warnings about trend reversal. It's supposed to be a leading indicator. The idea being that the TCI might give you a leading warning about these bigger shifts that the MDC could then later confirm. And so it could be that a strategy based on both the TCI and the MDC could actually even be more effective than just the MDC on its own. So I'm curious to hear what you all think of this model. Again, it's one that I'm still tinkering around with a little bit, but I think it's pretty much fine, ready to go at this point. Or so it's one I'm going to start watching consistently as we go into these future parts of the market, because you know, we're in a bearish time in the market right now. I think we're all looking for something to give us an indication of when a reversal might happen. I'm going to start watching the MDC to see what it thinks. All right, if you like the content, remember to subscribe to the channel, give the video a like, and follow us on Twitter. Put out indicators, or excuse me, updates about our indicators and more over there.